Imagine someone quietly increased your monthly income by 3,000 rupees. You try to find out who. It was not your employer and definitely not the government. You do not even remember filling out a single form for the bank. It almost sounds impossible, but that's exactly what happened to millions of Indians over the last 18 months. If you have a floating rate home loan, your EMI may already be lower. If you're planning to buy a house, your affordability has improved. And if you're looking for a new job, companies may have found it easier to invest and hire. And then, just when everyone expected borrowing to become even cheaper, the Reserve Bank of India suddenly stopped. One decision taken in one meeting in a room that you are not allowed in, and no more rate cuts. But why? And more importantly, what does that tell us about where India's economy is heading next? By the end of this video, you will understand why one interest rate influences everything from your EMI to your salary, your career, and even the companies that choose to hire next. Every couple of months, 6 people, the RBI's Monetary Policy Committee, sit around a table in Mumbai. No cameras, no speeches, one question. Should borrowing get cheaper or more expensive? Here's the timeline, and bear with me, it's worth 20 seconds. At the start of 2025, the repo rate had been parked at 6.5% for 2 years. Then, 4 cuts inside 1 year, February to December. 6.5 down to 5.25, and the RBI itself hinted there might be room for more. Then came 2026. 3 meetings in a row, February, April, June. No change. But why? Hold that thought. First, see what a rate cut actually does. And it's simpler than it sounds. Say you're repaying a 50 lakh home loan. One day, your bank messages you, "Good news! Your interest rate has come down." You didn't ask for it, you didn't refinance or fill any forms. So why this generosity all of a sudden? Here's the story. Your bank borrows money too, but from one place, the RBI. The rate the RBI charges banks is called the repo rate. Think of it as the wholesale price of money. When the RBI cuts its rates, your bank's own cost of funds drops, and it passes a chunk of that down to you. Your bank isn't being generous to you. It's just that their raw material cost went down. On that 50 lakh loan, the 2025 cycle took roughly 3,500 to 4,000 off the monthly EMI. All of it from 4 meetings in Mumbai you never even knew happened. Now, let me tell you something you already must have realized. Your EMI is the smallest thing a rate cut touches. The serious money moves inside company boardrooms, and that's where your career walks into the story. Because when money gets cheap, companies start asking a dangerous question. What can we build now that we couldn't afford last year? Say you're the CFO of a manufacturing company who has been planning a new plant for 2 years. Demand is there, the plan is solid, but one problem. The plant costs 300 crores, and most of that has to come from a bank. Last year, the math refused to work. Interest ate through returns like a kid with a chocolate bar, and the board said no, and the file went into a drawer. Then, the RBI cuts their rates. The finance team reruns the numbers, and the same file, the same plan, the same market now clears the bar. Nothing about the plan changed. Just one number moved, the cost of money, and that alone flipped a 300 crore decision from a no to a yes. Peel back almost any big expansion in this country, and you'll find borrowed money underneath. Now, this is literally the first thing they teach you in business school. Companies don't invest just because an idea sounds great. They invest when that great idea also survives the math. And the interest rate sits right in the middle of that math. Now, bring all of this back to you. Maybe you're a project manager, a developer, a marketer, or you're eyeing an MBA. Why should any of this matter to you personally? It's simple. Every expansion needs people, and companies only expand after they invest. And they only invest after checking the cost of money, which means today's rate decision quietly writes a part of next year's hiring plan. Quite possibly yours. Here's a small test for you. Two graduates read the exact same headline this year. RBI holds rates, raises inflation forecast. The first one thinks, okay, EMI stay where they are, what does it even matter to me? And simply scrolls on. The second one thinks, expansion loans just got riskier to plan. Some hiring will slow down, and anyone who can model these scenarios just became more valuable. Same headline, but 10 years from now, two very different careers. Why? Because one of them could see the second step. And that gap right there is the difference between reading business news and thinking like a manager. Which brings us right back to the mystery we parked at the start. If cheap money was helping families, funding factories, and feeding hiring, then why on earth would the RBI stop? And that too, after so many meetings in 2026. Because sitting inside their own projections was a risk most of us never even noticed. Picture this. You are on an empty highway, foot on the accelerator, everything feels great. So why would you ever ease off? Because past a point, the speed itself becomes the danger. The interest rates behave the same way. Cheap borrowing pulls in spending, spending pulls in investment, and investment drives growth. That's the whole point of cutting rates. And through 2025, it worked beautifully. But here's the catch. When everyone starts spending at once, demand outruns supply and prices start climbing. And that, right there, is inflation. A little of it is fine, healthy even, but too much of it too fast, and your salary simply stops keeping up. Now run this in your own house. Salary up 5% feels like a win. But if groceries, petrol, school fees, and rent all climb 10% in the same year, you're technically earning more on paper, but actually living worse in practice. And that is the exact outcome the RBI is paid to prevent. And this is the trap every central bank lives in. Cut too hard and inflation wakes up. Hold too high and companies stop investing. Growth cools down, hiring cools down. There's no free option here. Every choice costs something, and the job is choosing which cost the country can afford. So, what did they see in June? Their eyes were on tomorrow's inflation, and tomorrow looked messy. The West Asia conflict had pushed oil prices up and kept them jumpy. The rupee has weakened, which makes every imported barrel even costlier. The monsoon forecast raised food price worries. And when RBI updated its own numbers, it raised this year's inflation forecast from 4.6 to 5.1%, while quietly trimming its growth forecast to 6.6. In plain words, the road ahead looked far less predictable than the road behind. So the committee, all 6 of them, voted the same way. Hold. Growth was still decent, but protecting next year's prices mattered more than squeezing out a little extra growth today. And sometimes the smartest move a leader makes is choosing to do nothing, on purpose, with a clear reason ready. That's what the RBI did in their 3 meetings in a row. Now, if you stayed with me this long, you probably already clocked what this video was really about. The RBI was just the excuse. The subject of interest was decision-making. One great announcement just walked us through finance, strategy, hiring, inflation, and leadership all tangled together into one single choice. And that's how business problems arrive in real life. They definitely never come with their subject labels. The managers earn their salary by connecting the pieces. It's also why business economics sits in the very first semester of nearly every MBA. Because every manager, whether you're pricing a product, planning headcount, or building next year's budget, keeps running the same 3 questions. What if the rates move? What if inflation climbs? What if demand cools? And today, no manager runs those questions alone. They run them with AI. AI took over the calculation part, but the judgment, deciding which trade-off to accept, that is still very much a human job. And it pays better than ever. That's the exact muscle our online MBA is built to train. Connecting ideas, weighing trade-offs and making calls with both management frameworks and AI in hand. The link's in the description if you want to dig in. Before we close, here's one habit I want you to take with you. The next time a business headline crosses your feed, skip the what happened part. The article already covers that. Instead, ask 3 sharper questions. Question 1. Who benefits? Every decision creates winners. In today's story, cheaper rates rewarded homebuyers, borrowers, and every industry that runs on investment. Question 2. Who pays the price? Because there's always a bill. FD savers earned less through 2025, and once the cuts paused, some expansion plans went right back into the drawer. And question 3. What happens next? Most people stop at today's news. A manager immediately asks about the second-order effect. Which industries grow? Which skills get expensive? And where should I be standing when that happens? Answer those 3, and a headline stops being just information and becomes an input to your next decision. This week's challenge: open any business headline today, any one at all, and run these 3 questions on it. Who benefits? Who pays? And what happens next? Manage that, and trust me, you are already thinking like a manager. Drop your answer in the comments, and the best one gets featured next week. Every day, the news tells you what happened. This channel exists for the other half: why it happened, what comes next, and what it means for your career. If that sounds like your kind of thing, hit subscribe, and I'll see you the next episode of Business Behind the News.